Howdy out there, folks. This is Darius Dale here to present our macro minute for Wednesday, May 4th, 2022. It is Fed Day, game day. See the helmet in the background? We are bringing all the heat and all the smoke to you this morning and this afternoon. So we'll catch back here on the Real Vision Daily Briefing as well at 4 p.m. Eastern with our recap of today's FOMC and Treasury quarterly refunding announcements. Starting with asset markets this morning, stocks mix this morning with U.S. equities positively diverging, although small. Commodities up, crypto up, dollar down, global bond yields mixed with European rates positively diverging. Market moving headlines. Obviously, the Fed today is expected to raise interest rates, its Fed funds rate by 50 basis points today, which would be the biggest hike since 2000. Where were you in 2000? I was in seventh grade in 2000. This is before Wi-Fi, before cell phones were popular, before Teslas and all that, before Bitcoin. Oh my God, it was a world before Bitcoin. So it was a long time ago. So obviously that didn't end well in terms of the 2000 and 2002 stock market collapse that we saw. I think the S&P 500 was down about 50%. NASDAQ was down about 80% peak to trough. Let's hope we avoid that outcome here. The FOMC is also likely to unveil its plans for quantitative tightening, which could and likely will begin later this month. Shifting gears across the pond, the ECB, you got ECB Executive Council member Isabel Schnabel. She came out and said, from today's perspective, obviously looking at the data, she thinks a rate hike in July is possible. I mean, the ECB hasn't hiked interest rates, I think, since going back to Trichet's final last dance in 2011, just into the teeth of the Eurozone sovereign debt crisis, not to be outdone by himself in 2008 into the teeth of the global financial crisis. Jesus, that guy was not good at central banking. But Draghi was, though, obviously fantastic central banker. Shifting gears also to EU proposed a complete ban on Russian oil imports that'll be phased in over the next 6 months, and a complete halt to refined fuel purchases by the end of the year. Hungary and Slovakia, which have much closer ties to Russia from a political risk perspective, who have been opposed to a swift cutoff, will have until the end of 2023. Doesn't matter. It's obviously Germany, France, et cetera, that really matter here. The bloc is also proposing to cut off Sberbank and other lenders from SWIFT. So this is going to completely cut Russia off of the knees. If you're talking about removing their biggest customer and biggest source of demand and biggest source of funds, it'll likely kind of embolden Vladimir Putin, who is very clearly a wounded soldier here and acting irrationally with respect to the further advancement on the war front in Ukraine. Still a tragic situation there. Just going back to the Fed, we're going to be unpacking all of the various scenario analysis, not just with respect to the immediate reaction to today's Fed meeting, but also the ensuing couple of months. We got a lot of moving parts to talk about in our macro scouting report, which is our monthly deep dive presentation, usually about 100, 125 slides of hard-hitting analysis. We'll unpack our updated European economic projections. I feel bad for any investors in companies who sell a lot of stuff to Europe, because guess what? Our European growth forecasts are likely coming down as a function of the function of the data, but really there's stochastic forecasts. But certainly I would expect the balance of risk to be skewed to the downside there. And then last, I thought this was interesting. We're still in earnings season. I mentioned this was a big macro week in the middle of earnings season, but the earnings do matter. You have Airbnb down 5% in pre-market trading today, despite beating and guiding to substantial demand for travel heading into the busy summer season. So, this is one thing I'll call out. Look, the company beat, they guided up, and the stock's down 5%. So I want everyone out there, particularly those of you who are not, trained investors who are working across the buy side right now, the guys and gals on the buy side are better than FinTwit. So be careful with that everybody's bearish narrative. If they're selling a stock that beat and raised guidance, it's telling you that the whispered numbers on the buy side, the outlook for earnings is deteriorating, and it's not all as everything. This whole concept of everyone being kind of bearish, based on these loose sentiment surveys, is really, it can get you in a lot of trouble if the buy side really starts to sell stocks in mass as a function of the profit cycle. Big movers this morning. You have WTI crude oil up 9% to 9% month over month on this ECB news. You got Bitcoin and Ethereum 3% up 3% a piece to down 16 and down 18% month over month respectively. I think there's a little bit in the crypto market as a function of further cutting off Russia's access to euro and dollar financing. So you're getting a little bit of speculation there. We again down 16, down 18% month over month. We had a hell of a trade, booked some gains there from a nice trade through late March to early April. And then obviously we've seen crypto and a lot of things collapse since then. So let's keep it moving. We're having a good year. Looking to our volatility adjusted momentum signal and probable range analyses. Starting with the dollar here, Bloomberg Dollar Index, that's bullish fams, with minus 1.8% of downside versus 0.9% of upside in its probable range. Gold still neutral VAMs this morning, still at the lower boundary of its probable range with 5.6% upside. 10-year nominal treasury yield, bullish VAMs, still kind of a fair fight, 19 basis points of downside, 25 basis points of upside. High yield OAS, looking at the CDX, neutral VAMs still with 46 basis points of downside and 17 basis points of upside. S&P 500, that is bearish VAMs. We'll talk about the setup in terms of potential squeeze risk. Remember, we got the squeeze 6 weeks ago on the March FOMC. We'll unpack that and lead off morning note today as well in terms of how high could we squeeze if we see either dovish breadcrumbs or just an inline statement. Again, going through all those scenario analysis. So subscribe if you want the real what to do. So the bearish VAMs minus 5.1% of downside versus 4.7% of upside. VIX neutral VAMs minus 32% of downside, 21% of upside in its probable range. NASDAQ bearish VAMs minus 7.5% of downside versus 5.7% of upside in its probable range. Russell 2000 still bearish VAM, still looks like a dog, minus 6.3% of downside versus 4.5% of upside. Bitcoin still bearish VAMs minus 11% of downside versus 5% of upside. Ethereum still bearish VAMs minus 12% of downside versus 6% of upside. Shanghai Composite still closed, bearish VAMs, same setup, minus 5% downside, 4% of upside. WTI crude oil, neutral VAMs, minus 11% of downside versus 7% of upside. And then lastly, agriculture, neutral VAMs, minus 1.5% of downside versus 4.6% of upside. So a decent risk reward there if you're still looking to get involved in the commodity trade on this deteriorating geopolitical risk dynamic. We talked about this in February. We said this is not a situation that looks like it's going to be over soon. And that continues to come to fruition. You got to make calls if you want to make money in financial markets. It's not about tweeting. It's not about, guessing. It's not about playing both sides of the fence. Put a damn trade on. You either make money or you lose money and move on. Next play. Industrial metals, neutral. I'm sorry, I'm a little fired up today. I woke up very excited about this Fed meeting. So apologies for the extra energy, but actually not apologies. It's my program. Who cares? Minus 2.3 or sorry, we're still oversold with minus 10.7% of downside to the upper boundary of its probable range. So with that, Darius Dale presenting our macro minute for Wednesday, May 4th, 2022. May the 4th be with you today. Got that from my man, Mickey. Cheers.